This is Jim Lee with Strategic Foresight Investments, and I'll be sharing with you some investment perspectives and forecasts for the second half of 2015. So lots of charts and graphs coming up. If you want to go into full screen mode on either your laptop or your desktop, you'll be able to see things a little bit more clearly. So overall, stocks have been continuing their 5-year bull market, but moving a little bit more sideways, running from February or March. We've been somewhat range bound with resistance for the S&P 500 at the 2140 level, with primary support at the 200-day moving average at 2050, with secondary support at 1990. So we're coming back from an oversold position resulting from the ongoing Greek tragedy and weakness in the Chinese markets. And I'd suggest that we'll probably continue to move sideways for the next month or two for stocks within this trading range, with a breakout going into fall and anticipating, I'd say, positive returns, mid to high single digits, maybe the 4 to 8% range by year end for the S&P 500. Now what's kind of interesting is for the first time in a while, U.S. stocks have been weaker than the economy in general. From a big picture perspective, unemployment is now at around 5.5%. Consumer price index is basically dead flat, largely as a result of low energy prices and a strong U.S. dollar. And this has led to fairly high levels of consumer confidence, now 100, basically where it was in terms of 1980s, which is, I think, kind of interesting, and stronger retail sales here in the U.S. as well. So while stocks have been flattish, I think the overall economic environment is really quite benign at this point. So not all stocks are created equal, and that's been particularly the case this year. What we have here is a market map, which is a really useful tool for looking at all of the companies within the S&P 500 at once. It's fairly easy to read. Green is good, red is bad. The big boxes represent larger companies and the small boxes represent smaller companies. So a few things will jump out right at you here. First of all, the strength of the healthcare sector as a whole, and also the weakness in both energy stocks / basic materials, and also utilities. And during our January update, I mentioned that I felt that utilities were a little bit overpriced. That may have been true. Many of these companies have pulled back 7 to 10% since the beginning of the year, and could be worth a second look at this point. So this raises the question of what drives performance within each of these sectors, and I would suggest that it's earnings growth. And to the left we have some analyst estimates of earnings growth, with the strongest sectors being both finance and healthcare. Weakest sector continues to be energy, with a lot of energy companies earning less than half of what they earned last year, if they have earnings at all. And this brings earnings growth for the S&P 500 collectively down to about 1.7% for the year. So it's still positive, a little flatter than usual. Now we have something called a sector rotation model here at StratFI, by which we increase our exposure in those sectors that are lending or seeing outperformance relative to the market. So our exposures right now are in both the financial and the healthcare sectors. And this is a chart of some of the ETFs in those areas, with healthcare in purple, banks here in red, with returns of 18% and 8% respectively year to date. And that actually compares quite favorably relative to the S&P 500, which is up around 2 or 3% on a year-to-date basis. So we'll continue to monitor this going forward. Now I spend a lot of time looking at getting the timing right, and there are some assets that I think are going to be fading out of popularity, and we'll see lower performance going forward, especially in the bond market. particularly if we see an increase in interest rates by year end. I think it would be reasonable to believe that the Federal Reserve will increase short-term rates by 0.25% by the end of this year, and that will, I think, put a damper on bond prices. There are some segments of the market that I think are just a little bit too early to get in on right now in a big way. Those would include petroleum stocks, mining stocks, and emerging markets, all of which are dependent upon strong commodity prices, which we really don't have right now. So the things that I continue to find interesting, again, healthcare stocks and financial stocks. The banks may be early beneficiaries of higher interest rates for the U.S. Health insurance companies are in the middle of merger mania. And from a valuation perspective, I think that property casualty companies as a group are very attractively priced, with many of them trading at a deep discount to the S&P 500. Some of them with price earnings multiples of 10 to 11 times earnings. In terms of technologies, I continue to have a lot of exposure to the Internet of Things. This is about connecting the physical world to the Internet. And if you think about it, over the last 20 years, we've gotten 5 billion people on the Internet. But over the next 10 years, we'll likely get 50 billion objects on the Internet. And they're all going to need sensor chips, transmitters, internet access. It's a whole ecosystem of technologies that goes together here, and I think it's really the biggest technology trend that we're in the middle of right now. I'm also doing some research on data security companies. There have been some very high-profile hacks, not only of Target stores and Sony, but also things like the U.S. Department of Personnel Management and even Major League Baseball recently. So companies are going to be spending a lot of money making sure that their networks are secure. Finally, in terms of kind of cutting-edgy things, I'm actually very intrigued by the prospects of wireless energy transmission right now. Basically, signing up to a power supply that's transmitted wirelessly, almost like a Wi-Fi, in some cases password enabled, to charge and recharge your mobile devices, cell phones, laptops, watches, etc. And this actually is a nice way of getting around the whole battery problem that everyone seems to be dealing with for the time being. So this is a technology that does exist. Very few people know about it, but I think it's going to scale up fairly significantly over the course of the next 5 years. So a few interesting things to watch here. We'll continue to write about these in our newsletter, and you may see some of these in the portfolios of our clients. But I just want to thank you for your time and your interest. If you do have questions about investments or the markets in general, feel free to send me an email at jlee@stratfi.com or give me a call here at the office. Thanks again.